Chapter 8. Chapter 8 is very light again chapter and explains two different methods for costing. One is the absorption costing, the other one is the variable costing. What's the difference between one and the other? Now, as you already know, we have a product cost and we have a period cost. Also, based on the cost behavior, we split the cost on the variable and fixed cost. Now, on the product cost, we have direct material, direct labor, and manufacturing overhead. And we already saw that manufacturing component can be broken on the variable manufacturing component and fixed manufacturing overhead. Same is applicable to the period cost. They can be broken on the variable cost and be broken on the fixed cost. For that reason, we can have absorption costing and variable costing for the product. What means that? Let's go with the variable costing. On the variable costing, product costing. Now, listen carefully. Variable product costing, including only the variable manufacturing overhead. Not all the variable cost. Don't include the variable selling administrative cost because that's a period cost. Including variable costing, including in the product, only and only the variable manufacturing overhead. So that will be direct material, which is a variable cost, direct labor, variable cost, variable manufacturing overhead, variable cost. So that's your product cost. Where absorption for the product, absorb or taking inside itself the entire overhead. So that will be direct material, direct labor, variable manufacturing overhead, and the fixed manufacturing overhead. So the difference between the absorption costing and the variable costing is the fixed manufacturing overhead. In the absorption costing, the fixed manufacturing overhead goes in the price of the product or increasing the inventory. When in the variable costing, the fixed manufacturing overhead is treated as a period cost and not part of the costing. So basically, if we compare the product cost between both methods, absorption costing, always the product will be with a higher price or higher cost. With the variable costing, the product always will be lower cost. Why? Because the variable costing doesn't include the fixed manufacturing overhead, where the absorption, including the fixed manufacturing overhead. So let's see the first. Which method will produce the highest value of the working process and finished goods inventory? Having in mind that in the product, in the inventory, we're carrying that additional absorption, fixed manufacturing overhead cost. So which method is going to give it the highest value of the working process and finished goods inventory? What do you think? Any guess? Any guess?
C.
Why C?
Because
so listen to this. Again, in the product here, we including the fixed manufacturing overhead. And as I said, our product here is more costly. The cost per product is higher than the variable cost. Having this in mind, which you're going to carry the highest finished goods inventory?
Absorption.
Absorption. Make sense to everybody? Let's see one example now. This company producing a single product. The following is the information. They're producing 25,000 units. Now the variable cost is direct material, direct labor, variable manufacturing overhead $10. Selling administrative expenses $3. Fixed cost per year is manufacturing overhead $150,000, and the selling administrative expenses is $100,000. So As you can see here, we have variable cost per unit and fixed cost usually in total. Having this in mind, what will be the fixed manufacturing overhead per unit based on the $25,000 or 25,000 units produced? Who's going to tell me?
6.
$6. How did you get it? 150 divided by 25, right?
Yes.
Perfect. So the fixed component here is $6. So let's calculate the product cost. Absorption, again, is going to include direct material, direct labor, variable manufacturing overhead, plus the fixed manufacturing overhead, which is $6, or the product cost will be $16. When under the variable costing, the product cost will be only $10. Why? Because we're not including those $6 into the variable cost. Those will become a period expenses. Now, we're producing 25,000. This is based on the 25,000 units. Absorption costing 16, variable costing 10. Now, first scenario, assume that the following additional information for the company. 20,000 units are sold. There's no beginning inventory. Zero inventory. We're producing 25, but we're selling only 20. Let's see what's going to happen now. Under the absorption, sales will be, since we're selling 20,000 times $30, 600. Cost of goods sold will be calculated. No beginning inventory, right? We're producing 25, and the cost per product is 16. That's 400. But we have ending inventory, right? Because we produce 25, but we sell only 20. Our ending inventory will be 5,000. Times $16 cost per unit will be $80. So our cost of goods sold, which is related to the 20,000 units, is only $200,000. Gross margin is $290. Now, on the sales and administrative expenses, we're going to include the variable cost on the 20,000 that we're selling, or $3.60. Fix, which is given, and the fix is exactly 100,000, same as the expenses. And that's going to give us a net operating income of the $120,000. Now, what we have to understand is that the fixed manufacturing overhead here, the fixed manufacturing overhead is absorbed by the ending inventory. So here we're going to carry additional 30,000, which is related to the additional $6. Where were those $6 here? And we have 5,000 units ending inventory. So those 5,000 units, we're going to carry that additional $6. So we're going to have here 80,000. So let's do the same thing for the variable cost. On the variable costing, sales will be exactly the same. Now, beginning inventory, we start with 0. Now we produce 25,000 units, but cost per unit was $10. So our cost of goods manufacturing now will be lower, 250. Ending inventory, since we're carrying only 5,000, times $10 will be 50,000. So as you can see here, that's the first difference that comes, because here on the ending inventory here will be with $30,000 less. Why 30,000? Because those $30,000 in the variable costing is going to go directly to the part of the expenses, fixed expenses, where in the absorption, those $6 will be absorbed by the products. So here we're going to have $30,000 difference, 80 versus 50. Then because here we're doing contribution format, then we're going to add the variable period cost, which is related to sales administrative expenses, which will be exactly 60 like the previous one, right? Here we have 60, here we're going to have 60. And that's going to give us Contribution margin 340. Now, in this method, in the variable costing, we treated the fixed expense as a period cost, so we expense everything. 150 we expense it. Those 150 and 100, those become a fixed cost, so they're expensed. So, since our inventory here is $30,000 less, that means those $30,000 are included in the expenses. So that means that our operating income under the variable costing should be exactly $30,000 different than the absorption. And since the cost, those additional $6 are directly part of the expenses, absorption costing we're going to generate under the absorption costing, we're going to show a report which have net income with $30,000 more. Where those 30,000? Those $30,000 are related to the ending inventory, where the cost, those $30,000 are held in the ending inventory here and not expensed. When in the variable costing, those $30,000 are directly expensed. Make sense? So that's why we're going to have this. Now, on the absorption costing, we're going to have variable cost, 200, cost of goods sold, 300 on the absorption. Then here we're going to have 200,000. The fixed manufacturing overhead will be the difference. Then on the ending inventory, we're going to carry ending inventory with $30,000 more. So that's going to give us period expenses. We're going to come here with 150. That's why here we're going to have difference of 30,000, which is 150. Now they're split between the cost of goods sold in the absorption and the ending inventory. So that's why under the variable costing, our net operating income will be 90,000. Absorption costing will be 120. Why difference 30,000? Because the $30,000 will be held in the inventory under the absorption in the $5,000 ending inventory, which is going to hold the fixed manufacturing overhead cost. Now, let's see the next year. What's going to happen next year? Now, we're still producing the same number of units. We're still producing 25,000. But the next year, we're selling 30,000 units. Means that we're selling what we produce, plus we're selling the beginning inventory. So we wash out the inventory to zero. Unit sales price $30, no change here. Direct material $10, manufacturing overhead $10, selling and $3. Fixed cost per year, manufacturing overhead 150 divided by 25 produced, still $6 fixed manufacturing cost per unit, and selling and expenses 100,000. Let's see what's going to happen now. What will be our cost? Product cost. Under the absorption costing, still be 60. Variable cost $10. So there will be no changes in the cost of the product. Now, if we have to prepare the income statement, now the sales, since we're selling 30,000, is going to be 900,000. Now we have beginning inventory of 80,000 from the previous period. 5,000 times 16. We're producing 25 times 16, 400. And we're selling everything in this case. We don't have any inventory. So our gross margin will be 420. The variable cost, variable expenses here, which is the period expenses, will be based on the selling administrative expenses, 30,000 times $3, 90,000. And the fixed 100,000 each time. So the net operating income here will be 230,000. What you need to notice is we wash out the beginning inventory, so we don't have any inventory. And as you remember, here in the absorption, we have $30,000 cost hold more than the variable. Let's see what's going to happen with the variable. Variable sales will be the same. The beginning inventory is lower. Instead of 80 is 50. Cost of good manufacture also is lower because the cost, our cost product is only $10. No ending inventory, so the entire is going to go as a cost of goods sold. We're going to add the variable portion of the same administrative expenses, which is 90,000, same as the absorption, no difference here. That's going to give us that contribution margin. For the fixed expenses, we're going to expense everything, 150 again, and from the downside administrative expenses. So since our inventory is $30 less, cheaper than the absorption, this $30, once we wash out the inventory, this $30,000 is going to show up in our operating income. So under the variable costing now, we're going to have a higher income versus the absorption, 30,000. Why? Because now we don't holding the $30,000 in the inventory. We release those $30,000 and transfer to the expenses. For that reason, our operating income is less. Let's see what's happened now. Variable costing, 260. Why? Because the 5,000 units which holding six extra doors are released and come to the absorption costing of 230. And the $30,000 is related to the beginning inventory. If we have to compare the income from the absorption and the variable from the first year and second year, we're going to see this. Absorption first year generate 120, which is $30,000 than the variable. In the second year, absorption is lower than $30,000, which $30,000 flow to the variable cost. In overall, if we start with zero inventory, remember here the inventory in the first period was zero in the beginning. The second year, at the end of the period, the inventory is zero. Once we start from 0 to 0, there will be the same income we're going to generate under the both methods. So the conclusion that we can make is, if our production is more than the sales, we're producing more than we sell. That means we're increasing the inventory. If we increase the inventory, absorption income is going to be higher than the variable income. Why? Because part of the cost will be held in the inventory. Second conclusion, if the production is less than the sales, we're going to decrease the inventory. If we decrease the inventory, that means under absorption, we're going to have a higher cost of goods sold. And since we increase the expenses, our operating income under the absorption will be lower than the variable. And if we're producing whatever we sell, there will be no change in the inventory. That means there will be no change in the absorption of variable. So that's the only way that we have no change in the absorption of variable when we producing exactly how much we sell, or we're selling what we produce. That was the example. So far we saw example when we're producing both periods the same amount, but we're selling in both periods different amounts. So let's see what's going to happen if we're selling both periods the same amount, but we're producing different amounts. So in the first period, we're going to produce 30,000, but we're going to sell only 25. So we're building inventory. Since we're building inventory, the logical thing is absorption is going to have higher income than the variable. Let's see if that's the case. So the unit price, we're still selling for 30, direct material labor $10, manufacturing overhead is 150. But now, fixed manufacturing overhead per unit, it's not going to be $6 because we're producing 30,000. In this case, our fixed manufacturing overhead per unit will be 150 divided by 30 is going to be $5. So under the absorption costing, our product is going to cost $15. Under the variable costing, it's going to cost us only $10. And if we have to prepare the statements, they're going to be similar. So we're going to start with the cost of goods sold. We're selling 25,000 for $30, which is $750. No beginning inventory. We're adding cost of goods manufactured, 30,000 times 50. Then we deducting the ending inventory, which is 5,000, right? Because we produced 30,000, we're selling only 25. So that means different ending balance, building ending balance of the inventory with 5,000. Times 15, 75. So our cost to gross margin is 375. Variable costs are variable costs on the period side, and the fixed cost is 100,000. So our operating income is 200,000. So now the difference is $5 between one method and another method. The ending inventory is 5,000. 5,000 times $5, that's $25,000. So we should expect under the variable costing, our ending inventory to be $25,000 less than absorption, and our operating income to be $25,000 less than absorption. Let's see if that's the truth. Under the variable costing, sales, same sales. Zero balance on the inventory. We're producing 30,000 times $10. Ending inventory is 5,000 times $10, 50,000. So we have, that's the first difference, 75 versus 50,000. That's 25,000. Why 25,000? Because that's related to the $5 which are held in the ending inventory for 5,000 units under the absorption. Then we're going to have the same variable sales and administrative expenses, 75, 75. Contribution margin, manufacturing overhead, the entire manufacturing overhead goes directly here. The entire manufacturing overhead, 150, it goes directly to the, what was that? Here, the manufacturing overhead is expense. Selling administrative expenses between both methods is the same. So here we're going to have operating income 175. If we compare 175 to 200,000, our operating income under the variable costing, it's exactly $25,000 less. And as we said here, as long as we build up inventory, we're increasing the inventory, absorption is going to show higher operating income than the variable. So absorption shows 200,000, variable 175, which is absorption is higher. How much higher? The amount that is held in the ending inventory. Difference between the absorption and the variable costing, which is exactly $5 times 5,000 units, $25,000. Next period, we're still going to sell the same amount, 25,000, but we're going to produce less, 20,000. Why? Because we have beginning inventory of 5,000. Now, variable cost is going to stay the same. Fixed cost per unit, manufacturing fixed cost per unit is going to change now because we're producing only 20,000. So in this case, the manufacturing overhead cost will be 150 divided by 20,000, or $7.5. So the cost for product cost for under the absorption, it's going to carry 750 on the production side for the 20 units that we're producing. On the variable costing, there will be no change. It's still going to be $10. So let's see on the income statement. Now, remember, we're holding the beginning inventory, but the beginning inventory is cost of $15. And we already know that we're holding in the beginning inventory $25,000 difference between the absorption and variable. And since we're releasing the inventory, we're not having any inventory, and we're selling everything that we produce, those $25 going to be transferred to the expenses. Variable cost will be that much, fixed cost will be the same, and our operating income will be $150,000. So by the chart here, when we have production less than the sales, which in our case, we're producing 20,000, but we're selling 25,000, we're decreasing the inventory. In that case, absorption is going to show less operating income than the variable. Let's see if that's the case. So technically, we should expect the variable to be higher. How much higher? With the difference in the beginning inventory, which is $5 times 5,000 units, 25,000. So our operating income under the variable should be 175. Let's see if that's the case. Well, that's exactly what happened to be the case, because now we're not holding the beginning inventory where we have the $25,000 difference from the previous year. Cost of goods manufacturing the same. Variable expenses, 75. The entire manufacturing overhead and the entire sales administrative expenses are expensed. And that gives us operating income of 175. 175 is exactly $25,000 higher than the absorption. Why? Because we release the inventory, or the more expensive inventory in the absorption already moved to the expenses, and that transferred to the operating income. So, conclusion. First year, absorption generates $25,000 more than the variable. Second year, absorption generates $25,000 less than the variable. Variable stays the same. Total, all the same. Why? Because we start with the zero inventory and we end up with zero. What's the conclusion that we can make? Net operating income is not affected by changing on the production when we're using the variable. So we're producing more stable income. Net operating income is affected by the change in absorption in the production using the absorption cost. Even though we're selling the same number of units. That creates a problem, and we're going to explain this one. Now, the variable costing is only affected by change in unit sales, not affected by the number of units produced. And as a general rule, when sales goes up, net operating income goes up, and vice versa. Absorption costing is influenced by the changes of units of sales and unit of production. So the net operating income can be increased by simply producing more, because those are not sold and carrying that cost. Now, which are the people against the absorption cost? Those people argue that the shifting fixed manufacturing overhead between the periods can lead to the wrong decisions. The opponent against the variable costing argue that the variable costing are easier to understand because the net operating income is only affected by the change in unit sales. But this produces the net operating income figure that are more consistent with the management expectations. Absorption costing doesn't support, obviously, cost volume profit analysis. Why? Because then we have the mix between variable and fixed costs in the product side, where in the contribution margin or the variable costing, we can use the cost volume profit analysis. The treating variable fixed manufacturing overhead as a variable cost that can lead to the healthy pricing decision and produce the positive net income even when the number of the units sold is less than the break-even. So that creates the problem on the break-even. So once you do the break-even analysis, you have to be very careful and you ask the company what kind of cost system they're using. If they're using the absorption, you have to convert to the variable in order to do the proper cost volume profit analysis. Now, for the external purposes, what's going to happen in the external purposes? Absorption costing is required for the external purposes. Even Canada revenue rely more on the absorption, but permits both. Since the top executives are usually evaluated based on the external reports to the shareholder, you may feel that all the evaluation is based on the absorption. Which are the advantages of the variable? Now, when we're using the variable, management finds it more useful because they can apply cost volume analysis, can calculate the break-even, sales to the break-even, and all those. Net operating income is close to the cash flow, consistent with standard cost and flexible budget. Easier to estimate the profitability. Profit is not affected by the changes in inventory and impact of the fixed cost in the product emphasized. Absorption costing. What's the difference? Fixed manufacturing cost must be assigned to the product to properly match the revenue cost. When the variable, fixed manufacturing overhead are capacity cost and will happen even though nothing is produced. What's the impact on the lean just-in-time inventory? On the lean just-in-time inventory means that the difference between the variable and absorption costing will tend to disappear. Why? Because with the just-in-time, we tend not to have ending balance for the inventory. Whatever we sell, whatever we produce, we sell it. Actually, in the opposite way, the sales drive the production. Once we have the sales, then we can produce it. Another thing that I want you to understand is that if you're a smart manager, if you become to be a manager, and if you become to be evaluated on the net income, the simple technique that you can do is if you produce more than you're selling, and if you use the absorption costing, if the company using the absorption costing, you can easily tell the management, hey, I increased the operating income. And if the management doesn't understand the difference between absorption and variable, then you can easily get the bonus. That's one thing that the new manager is doing. What they're doing is they're producing more than the sales. So basically, they're looking on the pure perspective. What they're doing is they locking cash in the inventory. And since the cost and the absorption is higher than the variable, your inventory is overvalued. When the inventory is overvalued, that doesn't go as an expense on the income statement. That means that operating income under the absorption, once you build it, when the inventory increases, always will be higher. And you can use that as an advantage to get the bonus. And that's your chapter 8 and absorptions versus variable costing and the two methods.